Venture Partners. Really appreciate your time today for the panel on transformation and innovation in corporate banking. We have a fantastic panel today. We have Aditya Gaddam, CEO of IX Labs, who is also the moderator. So we will get into the introduction of the panel and we will get into the panel discussion. But before that, I would like to introduce EthAum Venture Partners. EthAum is a deep tech accelerator based in Singapore. We have 56 startups in our portfolio. All of these are AI, ML, blockchain, IoT, robotics, AR, VR kind of startups coming from different parts of the world, different stages and sectors. We love to work with the startups and help them acquiring customers, help them bringing partnerships, and help them scaling in different geographies. That's the core focus of EthAum Venture Partners as an accelerator. Now, I would love to make sure that we have enough time for all the interesting questions that Aditya has in his pocket. And we obviously have enough time to hear all the interesting insights and the innovation perspective that our panelists have. So I would pass it on to Aditya for a small intro about himself and IX Labs. Aditya, please go ahead.
Sure, thanks, Pankaj. Hi all. Again, thanks very much for taking time to join this. And I'm the founder of IX Labs. We are a startup based in North Carolina in the United States. Now, as regards my background, I've been a corporate banker and a management consultant specializing in banking, risk, and compliance. So my experience along with inputs from other industry leaders, has led us to identify and observe a few shortcomings in the client coverage technology ecosystem globally. Now that led us, to do some exciting things here at IX Labs, and we're proud to offer a corporate banking client coverage platform. That's a full cycle automation of the client coverage process in commercial or corporate banking, right? Like Albert Einstein said, problems cannot be solved by thinking within the framework in which the problems were created. So we had the luxury of existing outside that ecosystem and also thinking outside that framework and iteratively developed this revolutionary solution which would radically enhance any corporate banking client coverage process at a low cost, which again is a big boost in the arm for many, many banks, right? And in other words, it's future-proofing of every corporate or commercial bank and NBFC globally. And we are guided by industry-recognized leaders like Kevin Oden, who's the ex-head of risk at Wells Fargo till recently, and on the current board of directors at RMA, which is the Risk Management Association, among other leaders and mentors. And we are a part of the accelerator EthAum's current cohort. And I'm sure you'd get to experience our solution at any of the banks that you're associated with in the future. And if you are interested to learn more about our offering, please do drop me a line, and I'm very happy to take you through our offering, our company, and everything about us. And it is my privilege to be moderating this panel of distinguished leaders today in corporate banking and the related innovation areas. And without further ado, I will turn it over to the panelists and request them to briefly introduce themselves to the audience.
Probably we can start with Sundaresan.
Hi everyone, thanks for having me. My name is Sundaresan. I have around 27 years of banking experience. Most of it has been in a mix of a wholesale banking kind of role, covering both corporate banking and some amount of corporate finance and investment banking. 22 of those 27 years were with Standard Chartered. And happy to share my thoughts and experiences on the journey that Aditya and IX Labs have started on, and hope to learn by the interaction with the other panelists as well. Thanks again for having me.
Thanks a lot, Sundaresan. Sandra?
Hi everyone, I'm Sandra. I have around 15 years of experience in corporate banking, including also transactional banking as well. I'm currently working as an innovation catalyst in Citi Innovation Lab and helping people to get onto entrepreneurship, plus leading Fintech partnership portfolio here. Looking forward to exchanging some notes with the panelists.
Fantastic. Thanks a lot, Sandra. Sanjay?
Hi everyone, Sanjay. I have more than 25 years experience of investment banking and corporate banking, primarily into real estate and infrastructure space. I was with Citigroup and large part with Sundaresan in Standard Chartered. I actually left the bank 2 years back, and I'm actually doing basically a corporate. We're setting up a new firm in corporate restructuring and corporate finance, with the focus of raising credit fund. I'm happy to be here and share my thoughts and learn from the panelists and from IX Labs.
Fantastic. Thanks a lot, Sanjay. Unfortunately, we have another panelist. I think he could not join. But Aditya, why don't we do this? Let's get started with the panel discussion. One request that I have to all the participants is that please be completely open. Don't hesitate. If you have any opinion, any insight, any questions, you can unmute yourself. You can type your questions in the chat and ask those questions to the panelists. And we would love to, have a more interactive session than just a monotonous session. So please feel free to do that. Aditya, please go ahead.
Sure. Yeah, Prasanna could be a little delayed. He might be joining a little later. So that said, I guess I'm ready with my first question, which is related to transformation, in the area of corporate banking. So to all the panelists, what are the transformations that you have witnessed in the corporate banking industry over the last 2 decades? So if we could perhaps start with Sundaresan, that would be great.
Sure. The pace of change has accelerated a lot. The last 5 years have possibly brought in as much change as the previous 15. And if I may just toggle my thoughts, the first and foremost, which I have noticed in the last few years that I've spent outside in as an investment banker looking at corporate banking and other financial institution spaces, the existence of a data footprint and how little corporate banking, at least in India and the cross-border transactions I was involved in, how little even multinational banks use it. This was supposed to the Indian corporate banks who actually did much more data mining. And I found that during a 1-year stint with Axis Bank, that they were using much more than what Standard Chartered used to do, or I used to do, or Sanjay used to do at Standard Chartered. So the first driver of change is the existence of the large data footprint by corporate banking clients and the need for the banks to or access that data, mine that data, and try to come up with intelligence even before you start a marketing exercise on to fix your products and services onto it. Currently, lots of banks are too dependent on a human touch, not knowing that at least in the retail lending industry, most decisions are now actually devoid of any human interface. Everything from sourcing to funding in the retail lending industry, especially in India, is possibly 98, 99% digital. So in contrast, corporate banking has a much larger way to traverse to get anywhere close there to that threshold. The second point is industry specialization. I have seen that clients value insights, which, as Sanjay said, if he specializes in real estate, he is able to bring products and solutions which will be much more valued as an advice. And then on top of it, you can fit a particular solution or a product or a service. So industry specialization is the second wave of change, which is a must. It cannot be a generalist one-size-fits-all glove anymore. The third change is customized solution. While cohorts of customers are constituting an industry, but every client is unique. So to move from a generalist solution to a tailored solution is possibly the third. And so I'll just stop here and allow other panelists to share their thoughts as well.
Sanjay, what are your thoughts?
I think Sundi covered it really well, but let me build on what Sundi just said. There are two things which are very important in addition to what Sundi said. First and foremost is how you manage your risk, and how do you identify the risks, manage the risk, and during the whole transaction cycle, how you keep monitoring it over a period of a deal cycle. That's the first thing that has fundamentally changed from a paper-based or an Excel sheet-based, a lagged information coming to a risk officer or to the RM or to the regional manager. I think that has fundamentally changed in terms of the transformation. How you manage your risk, and B, in a typical banking environment, you are looking at two key risks. One is alpha risk and beta risk. Alpha risk is basically you choose a customer which you should not have chosen, and beta is you let go an opportunity which you should not have. I think a business transformation or the technology transformation, which Sundi is talking about in terms of having a data mine it and use the data to cover these two risks, I think there is a fundamental change in terms of how you're going to take out these two risks out of your way.
Mm-hmm.
Loss of revenue, and second is loss of capital. How you can take these two risks out of equation, or how you can reduce it. And the third and foremost is the speed of decision making. If you have this data, how quickly you can process that, how quickly, whether it is in terms of taking a business decision of executing a trade, or taking a business decision of exiting the trade, or taking a business decision to hold on to the trade, how quickly you can make the decision. I think you have a lot of data points, how quickly you have an ability to take the decision, whether you have systems and processes in place to take the decision, and three, once you take the decision, how you monitor it. I think the speed of taking the data, taking a decision, I think that is fundamentally which is seeing a major transformation. And probably that is where Aditya, products what you're offering makes ample sense, because if you collate it, entire thing, what Sundi said, or the two risks I covered, all translate to one simple: what is the speed of execution, speed of decision making, whether the decision is to exit, decision is to enter, or decision is to hold. I think that is where the technology and the transformation has materially changed over last maybe 24 months. If you add another element, which is called the COVID element, in this, where you're sitting at home, you're not meeting your clients, you're not meeting your colleagues, you're not meeting your risk officer, you're not looking at physical stuff. How in an environment which is work from home, where data is available on computer, with very little information or personal touch, how you can mine the data on your computer or on your screen, or through a series of small automated decision making process. I think that is where the world is going to go going forward with work from home coming in. You can still take decision making. You can still do decision making through an AI process in a retail world, because you have 5 parameters to look at. But if you want to take a decision in a corporate world, or in a corporate or investment banking, where there may be 5 parameters, but there are 50 variables attached to it. you're not looking at 5 by 5 metrics, but you're probably looking at 5 by 500 metrics. How fast you can use the data and analyze the data to make the decision. I think that is the real transformation which probably people are going to be struggling right now.
Understood. Now, that's very valuable, Sanjay. Thank you for sharing your thoughts. Sandra, what do you think? I mean, from an industry, from being within the bank and also at a vantage point and having to view all the external entities who do this also, what are your thoughts regarding the same? What transformations have you witnessed?
A lot of changes, and I totally echo the point on, the pace of change is so much accelerated. I want to, also continue on the point of the data, and I see that, on top of the layer of the availability of the data, what happens is that it gives us so much rich kind of insights right now that AI has become mainstream in banking. It's not the experimental stage anymore. For every model, of course, you have to train it, you have to put it in, pilot. But I'm talking about the maturity of AI utility in banking. It's become much more mature. And it's not just about the availability of the data itself, it's that whom are we making the data available to today? 10 years ago, it might just be the data analytics team, or maybe, just a few core team that has the access of the data. But today, there's so many people, there are so many, different teams are using data right now and running their own model. So definitely, the access of the data is empowerment for a lot of people in corporate banking. They can build their own use case, ranging from generating sales leads, going for fraud detection, or even understanding the specific customer behavior. So AI is definitely already going mainstream in corporate banking.
Gotcha.
I'll talk some more about the way that we manage product cycle in corporate banking. It has changed drastically. When I joined banking industry more than a decade ago, a lot of these products are just rollouts in terms of regulatory change, or in terms of catching up with the other banks. But right now, the product cycle, the design becomes such an important element, and we are actually starting from scratch, understanding the clients themselves. It usually happens in a more consumer-facing kind of environment, like retail banking. But corporate banking, transaction banking are definitely picking up in terms of the primary user research and understanding, what's the human-centric way to interact with these big corporates or, SMEs in order to understand the behavior. The last trend that I want to talk about is actually my core kind of, portfolio. There are such an openness about working in partnership, in collaboration with fintechs. I see a lot of improvement in that sense. It's not viewing like a one-way competition, but we are in an ecosystem that we are willing to open our eyes and see, who are the smaller players in the ecosystem right now that can enable the bigger bets. So I do see these a lot of, kind of shifting in terms of the collaboration mindset right now.
Gotcha. Brilliant. So Prasanna, if you're on the call, could you unmute yourself? All right. So I guess we could move on to related areas. I think each of you has also preempted my next questions or parts thereof, but I'll nevertheless pose those questions to you. So would it then be fair to say that, a greatest common factor from all of what three of you said, would it be fair to say that the industry is getting increasingly, corporate banking industry is getting increasingly commoditized? In order to gravitate towards reducing human intervention. Would I be right to say that? We could start with Sanjay.
Can you start with Sundi? I'm struggling with you right now.
Okay. So I would think to some extent, yes, the use of data makes the role of the human a bit lesser, but I would think it's only a matter of empowering the human behind the wheel so that he or she is able to get more done in the same span of time or with the same effort. So I do not necessarily see it as a substitution, but as a way of dramatically improving productivity, because a shotgun approach will be replaced by a rifled approach. And your knowledge of the client, even before you engage first, would or should be far higher, simply because you have dipped into the digital footprint that the client has left in terms of their engagements, which are captured in all kinds of public data sources, so that you already know have a much more sharper, crisper view of what the client and what the client's competitors and the regulators all are trying to do or headed towards.
Gotcha. Gotcha.
So maybe I can comment here. I think we really have to look into, what part of the bank is being commoditized. And there are two types of jobs that we are talking about here. And, if you are asking the person who's doing like routine and repetitive job that is going to be replaced by, data and AI, yes, very sadly, yes, it would be commoditized. And for the other part of the people who are very creative, thinking about the different use cases, applying the data and the AI to actually create new value for the clients and also, for the organization. No, that part will not be taken away. That part will only be thriving.
Gotcha. Wonderful. Sanjay.
I think it's a very interesting question. And it has aspects of what Sandra said or what Sundi said, according to me. If you have data, how best you can use it is the first question, and who is the best person to use what? I think that's the second question. If you are someone who is doing a routine work, who is looking at 15 things, he doesn't need full 5,000 GB of data. But if you are somebody who is at innovation, somebody who is looking for solutions, somebody who is trying to figure out and try to get an out-of-box idea, he would be the person, or the teams would be looking at all set of data and see what can be done and what cannot be done. I think the innovation will stop if you put a cap on the data and cap on the data usage, and if you try to optimize in the corporate banking world. Essentially, you are into retail and corporate banking, not into personal. When I say it's not into consumer banking, but into corporate banking world. The only question is how do you make a logical sense of tons and tons of information what you get from number of sources. So a filter probably is applied at first level, second level, third level, so that you can understand and mine the data in a format or in a ways and means which is useful to a particular team. For example, a transaction banking team, how will they mine the data is very different than a loan or a FX or a bond trader will mine that data versus a guy who is looking at a investment banking opportunity or an M&A opportunity. So the data requirement for all these guys would be very, very different, but it will come from the same set of information what you have on the client. So it's very, very important that once you have a data, you mine the data in a particular way that it is useful to the teams or to the set of people who are going to use the data. And therefore, you need to have proper filters, you need to have proper how you package, and probably Pankaj and his team would be more appropriate to see how you can put the data into various categories which are available to different set of people within the bank or outside the bank, So I think it's very important that an AI or an automation is used to filter the data which can be used by various set of peoples, because the same data will be very useful to someone, and it will not be useful to for any work for the same organization for a different team.
Gotcha. Gotcha. Now, in the same breath, Sanjay, could you also kind of compare and contrast the advancements in retail industry? For example, in the Asian part of the world, we see even a little store around the corner. They accept payments via payment apps like Paytm and so many others, right? Even even an auto rickshaw guy accepts payments using those apps. While retail has seen a sea change with regards to automation and disruption, how has corporate banking fared? Even if it means the technology ecosystem being able to support all the roles that are involved, all the roles that you just touched upon, like coverage function or transaction bankers, modelers, IT, and everyone else involved. How is it?
So are you asking this from a perspective of a client, or are you asking from a perspective of a corporate banker? The bank.
From corporate banking, I mean, you being a business user in the definition, right? And on the banking side, corporate banking side, how have you seen, the transformation in corporate banking and compare it with the transformation that happened in on the retail front? For instance, payments like Paytm, etc.
So the biggest and Sundi probably covered it a little bit is how you map your transformation to the transformation happening at your clients.
Mhm.
So the best of the banks or the successful teams are the ones who map themselves or who follow what their clients are doing. If your client has gone into transformation where they are collecting their payments through an X or Y or Z model, and if you don't transform yourself and map it to those innovations which your clients are doing, I think people are going to lag back. So the first and foremost transformation which are happening is basically by the need, where you are needed to transform yourself the way your clients are doing the business. A.
Gotcha.
Second, how you transform, and once transformation or one success story, how you can replicate with other clients. You set of client who may be doing certain things and which have yielded result, how you can scale it up and how you can sell the same product because you have innovated that product, you have delivered that product to a set of clients, how you can replicate it, because that is where you're going to have a cost save, and that is where you're going to win the business and win that client. You're going to win more clients. How you can replicate, or how you can offer the same solution to your other clients, and you can scale up the business. I think that's the second part. Is first you map yourself to the existing innovations which are happening within the corporate banking. Second, how you can scale up the business and take it to the other clients, and how you can use the innovation where you can actually go back to your client and say, hey guys, I can actually improve on what you have said. And that's probably the third stage, where you can improve on the existing innovation and say, okay, these are 2 or 3 critical things which are not working for you. If you do it this way, and we can help you in setting those processes and systems in place and use our banking network. These are the innovations which are very, very rapid, especially in two business areas. One is the transaction banking, and second is rates and FX. These are 2 large innovations which are happening into these two product verticals, where you need to be really speed up to the innovation which are happening at the client end, and B, your own innovation and your own innovative products which you can deliver and give idea to your clients to, and they may be right from cost save to faster delivery or ease of doing business, or some dollar save, or in terms of how there are a number of things which will be the drivers for these innovations.
Gotcha. Sundaresan, what do you think? What are your thoughts on the same?
The fundamental human psyche which is driving change, it's important to understand where are we all headed as a society, because when we talk about corporate banking or any other industry, it's all existing in the context of human society and human behavior. So there are 2-3 fundamental trends that are happening. First is that the younger generation today, which is what is driving the change, wants very low quote unquote friction. They do not want to sit and negotiate face to face and have an emotional burden. They would rather have the surety that, let's say, a blockchain can give. Okay. And I'll just try and just zoom past. What does a letter of credit really do? It gives you the peace of mind when you're across the Atlantic or the Pacific with surety of money when you ship your goods, right? Mm-hmm. Now, I see a blockchain completely doing away the need for a LC, simply because that can give you the same amount of surety or certainty of getting the funds or keeping your capital safe. Likewise, is a bank going to be in a corporate banking, your lending is a prime area of income. Now, is a bank which is burdened with a capital and a regulator and a very large transaction banking business to worry about and so on and so forth, is that bank going to be the best lender, or is that going to be supplanted by a variety of funds who can do that with a much lower number of people, because that's all they do for a living? They don't worry about interacting with the regulator or have the regulatory costs or have a need to keep depositors happy and to run a transaction banking machine. And the transaction banking machine by itself, today, earlier we used to say our products have to have more technology. Today, technology is the product. You can chat and move money. What could be frictionless than that? So we have to understand where society is going and then look at the transformation that will happen in corporate banking, which is a subset like anything else, and the change that it will go through. So it's not very difficult to imagine.
Gotcha. That's very insightful. Now, Sandra, before you answer the same question, let me also kind of throw in a wrench into the wheel, right? Don't hate me for this. But if you would, also wear your hat of a product developer specialist alongside, your AI hat, with the visibility into the innovation ecosystem that you are privy to, right? Because today, data, we talk about data, a lot of curated data, whether or not that exists, well, that's the El Dorado for every bank, right? But today, it's more or less like drinking from a fire hose. So whether it's touching on what both the gentlemen said, like product innovation, what product you offer, like LCs, letters of credit, like Sundaresan said, could be redundant going forward. So how flexible and adaptable are the corporate banking ecosystems or tech stacks today in order to A, be flexible, and B, also scale up rapidly? Time to market, if you will. Please.
I have to say that, we have to go back to the drawing board and say, what's the mindset that we need? Like drinking from a fire hose, getting new information every single day. There's so much noise in the market right now that we can't even, catch up enough, right? But I can't really agree more when, we say, why do we need some certain products? Like, is it because of the legacy, or is it just the market really needs them, or going back to the people who are using the product and say, what's your job to be done? What exactly are you using the product for? And what are we trying to help you achieve here? So I have to say that, going back to some points earlier that you mentioned, when we look at retail banking, how do we reflect it in transaction banking? To be honest, is actually one thing. It's at the end of the day is the fundamental, the society, is the customer behavior. And that, even though we don't have a crystal ball, but anything that get traction in retail banking, sooner or later in 3-5 years is gonna start as a wave into corporate banking, because those people are entering the corporates and those people are driving the change. So if you ask me, where corporate banking is heading to, just look at where retail banking is heading to. If there's a successful use case, try to get some sense out of there, and the insights are actually sitting there.
Gotcha. And also, on the same note, there are so many moving parts, right? In the corporate banking area, there's risk management, who keeps developing the risk models, whether it's the client rating risk, which is the PD, or the facility, or the collateral risk, whether it's the haircuts or anything else. And then there's the top of the line function, finance, which talks about RWA consumption and consumption of capital. So how are all these elements coming together today? And what's the envisioned path in order to get there? Well, at least from a bank's perspective, right? Because you're closely associated with that innovation area.
I think a lot of it is making banking actually invisible in some way. So if you think about it, today how we actually use banking, I think retail banking is getting better these days. But if you look at corporate banking, like every bank is a silo, and then you see a lot of complicated usage of the product that isn't designed in a very human way. And with open banking coming in, all we see is that be where your clients are, help them to understand your product and be able to use your product from day one, and not even have to teach them to use it. Like a lot of these sales training these days, I don't understand why they actually exist. Like, is that really a need to actually tell people how to use a product? When you get an iPhone, you don't really do that, right?
Right. Thank you for that. Sundaresan, what are your thoughts about that extension of the same question?
Aditya, I'm sorry, I'll have to interrupt you here because we have some interesting questions in the chat as well. So there's one question from Alok, and it is how open banking is disrupting the market for corporate banking and what banks need to do to be relevant. And if you could talk about any use cases which would be relevant in the future, then that would be fantastic. I don't know who wants to take that question first on open banking. Sandra?
Yeah, maybe I can comment on that. So I think the whole idea is basically, embedding banking services into the normal routine of the client themselves. Like, wherever they are right now, whatever they're using, make banking totally invisible so that it's actually at ease for them, building into their own whatever sort of routine they have right now. I think it's difficult for banking to digest that, because it's basically giving away, your experience to the other companies, because it's actually getting yourself, your products, your offerings onto other platforms that might not be controlled by you. I think there is still some sort of fear from banking itself, losing touch of the clients themselves. But there is no need to actually, afraid that too much, because there are actually people out there building better experience, and that's why the clients are actually leaning towards that, and making sure that you will be able to open those APIs, you'll be able to let your clients access your data, and actually it's their data on whatever platform that they want to, is something that is extremely important.
Mm-hmm. Sundaresan, what have you noticed?
So I agree with what Sandra is saying, and I'll just embellish it by saying the aim of where we are headed to as a society is you interact with another human being only when you want to, and that will be mainly for the purpose of socializing. It won't be for the purpose of work. Whenever it's the purpose of work and it brings along with it its own sets of um, you know burdensome things, you will try and automate it to the extent you can and do it with discretion. So I agree with Sandra that ultimately banking will have to become invisible, and corporate banking will follow retail or other forms of banking. But I do think corporate banking in the current form may struggle to exist. It will have to possibly split itself into more specialized transaction banks, because only then they will be possibly be able to be technologically and digital in nature, simply because both of capital reasons, regulatory reasons, and cost reasons, because they are essentially payments is now completely technology. The overlay on that will be the data, and the data mining will then determine how you lend. And remember, the person who makes the decision and the person whose balance sheet is actually used may be two different entities. Just the way it happens with credit bureaus and credit analytics companies and lenders in retail banking are already different, and in corporate banking may follow suit or may be forced to follow suit.
Gotcha.
That's my 2 bits.
Sanjay.
I actually have a bit contrarian view here. So I would actually put this into two buckets. One is something which can be automated and which is being automated, and what Sundaresan and Sandra spoke about are the innovation happening at the client end, and you're trying to map that innovation and trying to reduce the corporate banking which was involved till the time those innovations were not there. For example, in case of transaction banking or APIs, or in case of cash collections, or in case of your transaction, normal basic transaction banking products, you're mapping what your clients are doing, and that part of the business will get mapped to technology, and those businesses will can be easily based on the AI or tech platforms, and you can have your rates and effects also, which can go onto an app base or a tech based stuff, and there's a lot of innovation and a lot of products are being offered there. Hardcore corporate banking is where you have a human touch, where you deal with the companies and talk to them in terms of their present issues, in terms of their future plans, and that you cannot do it through automation. If you need to sit in front of the CFO and ask what are his top priorities, what would be what he or the management wants to expand or do a capex, or they are entering new markets. No, technology cannot do that. You don't have companies or corporates who are going to put their business plans into an automated system that you can see, or Citi, Sandra can see, JP Morgan can see, Morgan Stanley can see. There would be all human touches. An M&A transaction cannot be driven, or a bond transaction cannot be driven, or even thought about it, or a structured transaction, or structured trade, or a structured credit, or cannot be driven just by a client putting his needs on a technology which can be accessed by 15 people, including their competition. So I think we need to really differentiate between what can be automated and what cannot be, or what would not be required to be automated by the client side himself. Part one is well understood, but the part two, which is core to corporate banking, which is core to how success is between the corporate banks. I think that part of the business will require an human interface. You cannot take technology, you cannot automate that part of the business, because that's a very dynamic at the client end itself. It's not dynamic at your end, because that's very dynamic at the client end. If say JP Morgan or Citi wants to expand their reach in India, or they want to shut down one business in India, that's a business opportunity for some other bank. It needs to be discussed in person. It needs to be evaluated. you need to make business presentation, just evaluate the stuff, which cannot be done through an automation. You cannot run a process. Okay, this is the information. This is my portfolio. These are my business expansions. Just do it under automation. I don't think that's we are anywhere near to automation on that side.
Gotcha. So you're saying, regardless of automation, the CRM slash coverage functions has a very high component of human intervention. Would I be right in summing that up, Sanjay?
Yeah. For example, if you meet a client and he gives you an indication that they are doing business in 5 geographies and one of the geographies you're going to shut down, they're going to probably shut down or they're considering shutting down. That needs to go back to the risk, and somebody has to reevaluate what are the exposures they have in that market, what are the things they are doing with the client, what are the capex they were planning to do in that market for the same client. Now, you will, if you're on automation, you will probably hear it when it happens. You will not hear it 1 year, 2 years before it would have happened. Same goes for M&A transactions. Same goes for bond transactions. Same goes for a complex derivative transaction. Same goes for number of trades or the products offering what the corporate bank has. For vanilla transactions, which are typically retail or a consumer, which is cash and carry or whatever, vanilla transactions, you can always automate because number of transactions that the client end have increased. So you also want to, you follow what client is doing in innovation. According to me, innovation in the corporate bank is following the client in terms of what it's basically the lead is the client rather than you are the lead in most of the cases.
Gotcha.
Can I just give an alternate opinion to what Sanjay has to say? I think the pace of where we are headed is such that the face-to-face interaction will almost be akin to what we call as private in either banking or private as in flying. It will be very expensive and it will be very niche. That most customers won't be able to afford it. And this is not too far away. This is possibly between 5 and 10 years away. Only those customers will be able to pay the kind of fees that human touch needs to be there. The rest will all be straitjacketed and will be fit into solutions which will maximize value for, like in Sanjay's case, if a particular geography closes down, the client will have digitally to figure out an alternate. And that decision will be taken unemotionally. The client will completely agree that the bank needs to shut down that geography or that product or that service, and will digitally be able to, at much lower friction than one imagines it currently, be able to switch to an alternate. So that is the direction banking is headed towards, and corporate banking is hurtling towards, whether we like it or we don't like it.
So are you thrilled about that change, or what are the changes are you thrilled about?
Better we adapt it and be a part of it than be extinct or be forced to be bracketed in a place where you don't want to be as a business.
Gotcha. Pankaj, I think we can get the next question related to credit rating agencies.
Yep. There's next question in the chat from Arvind. How rating agencies are impacting the corporate banking? As we see many mutual funds and insurance companies look at the rating of a paper before subscribing to it. Do we think this would become standardized like an app for corporate clients also in near or distant future? That's another question in the chat. Who wants to take that one?
I'm happy to give it a go, since I started my career 28 years ago as a rating analyst, and I interact with rating analysts even today in my current role. ratings or credit evaluation or a credit view, opinion in a formal form is already very important. It's already a metric, a significant metric of capital allocation by every part of the financial ecosystem, not just banks or corporate banks. And that industry itself is changing. And there is still a lot of inefficiency in credit decisioning. Like we have seen at least 2 AAAs in India defaulting in the last 2.5 years. And there still are a lot of AAAs out there who possibly don't deserve to be. I'm talking only from an Indian perspective. And there are a lot of very sophisticated fund managers who are luring investors into those so-called AAAs simply because it suits them. So someone will come in and drive change, and the rating agencies themselves will change, the credit bureaus themselves will change, the credit view providers will be changed, and their business model itself may change from being issuer driven to investor driven. And the regulatory framework for wrong decision making will get more punitive. Make no mistake. Just the way asset managers are being asked to get paid in their own units, at least in India they are. And rating agencies and maybe individuals in charge of those decisions may have to carry part of the can of good or bad decisions. So it will be an iterative circular process of change, but that is well underway. Make no mistake.
Got it. Sanjay.
I think it's a bit tricky question if you ask me. Tricky in the sense that there are regulatory requirements to get, there are requirements at the issuer or a subscriber level to get to see the rating of the instrument or the company. The real question here is, how are rating agencies themselves adapting to this change in terms of the information? There's a huge amount of data which is available in the market with rating agencies, with issuers. And there's a huge amount of data which is available. And how are rating agencies geared up to mine the data and come out with the proper rating, A, at the first place, and B, how they are catching up or how they are up to speed in the data which is coming to them from various sources in doing what I will call it as a ongoing rating rather than reviewing a rating on a particular day.
Gotcha.
Okay. So rating is a continuous process, and the data which is coming to them is coming on a continuous basis. How rating agencies are going to look at this data on a continuous basis and give you on a what I call it as a prime time basis before it is too late. Like Sunday was saying, there are two companies who may not be rated as AAA, but they are still rated as AAA. Means that there is somebody who has more information on the company. Rating agencies or other rating agencies not looking at the data, they have no access to the data. How they evaluating that data? I think that is something which needs to evolve, where rating agencies also need to appear themselves by looking at complex AI models or use blockchains or use the data what comes out and be in nature rather than being a reactive in nature.
Can I infuse another sub-question into that while we're discussing that? Now, today, do we have, I know it's a post-mortem analysis in the way we've been dealing it in the corporate banking world, but today, is there a mechanism where the buy-side banks especially check that on a preemptive basis instead of saying, well, an XYZ Corp rated a certain script at maybe AAA or an investment grade, so to speak. right? And how do we validate that? Is there an internal checking mechanism to say, well, their rating is this versus our rating based on our own data is this? Do we do that currently? Does that happen in the corporate
This
bank?
this is core to your business. And this
No,
is
no, no, no. What it is, it's a very objective question, Sanjay.
so coming to that, most of the corporate banks, most of the global corporate banks have their internal risk models and internal risk ratings, which are mapped to the global rating models. If okay, so if your internal credit grade or what you call CG credit grade, internal rating of the client is based on the parameters which are very similar to what the rating agencies will rate them. Most of the people, and it's a dynamic one. So your internal rating models are based on what the rating agency will look at, and the regulators are also going to look at your rating models to arrive at a proper weight, and therefore you can assign that risk weight, and then you can look at what is your return on that risk weight. I think what we call it as the RORWA in one bank, in return on risk, which will be a which will be a key driver for your ROEs, which are return on equity on what the bank how a bank is effectively, in a very simple term, how a bank effectively deploying its capital. If you have $100 million of a capital, how effectively you are going to deploy that capital, whether you're going to put it on a CG, particular CG for a transaction banking product, for a different high risk CG for a FX product, for a very low risk CG for corporate credit grade to a loan product. I think that's a factor which is a very dynamic factor, and regulators are very keen to and watching it like hawks on how you credit grade your customers, and that is also mapped more or less to how the rating agencies will map. I think it's a very dynamic thing, and that's why I said it's a big question, because the rating agency will probably throw a downgrade or an upgrade much later than what the model should throw it, because you have more access to the data. You're day in, day out dealing with the, you would see the risk or indication of the risk much faster than the market, because you're banking with the client. You will see if there are defaults in the customer, has not paid you on the due date, you will, or he is not paying to his supplier on the due date, you will start seeing the stress much before your rating agency will see it as a bank. I think that's why I said it's a very tricky question, because you will the according to me, the rating agencies globally are at lag, and probably banks are more equipped to credit rate the customer than a third party rating agency. So from that perspective, it goes hand in hand, but internally you need to map your credit risk rating, and typically it's mapped to the global credit rating agencies.
Gotcha. Sandra, what do you think about that from an innovation perspective? What innovation happened there?
I actually want to pick up on the rating point of view. I do agree that banks have a fairly robust kind of risk rating when it comes to taking in information and turning it into a rating that we can based on that and lend to different corporates. But then I do see two big gaps here, and I say it's not one bank or two banks, it's like across the bank. First of all, the credit rating that comes in from external point of view only apply to investment grades of clients. There are a large proportion of the clients in the middle segment that do not receive a rating, and that's why the bank will have to subjectively and also based on the data that they receive to rate them. That is one. On the other hand, almost all of the risk assessment models are based on historical data. Like these are data that you receive maybe at best 6 months ago or 12 months ago based on audited financials, or a discussion that you have with the clients. You can do financial projection, it's your own projection, it's not operational data. Today, it's very few kind of opportunity that the banks are taking in day-to-day transactional data or operational data of a company to risk rate them according to their daily performance. It's just not that robust at this point of time. So there's a huge gap there.
Gotcha. Gotcha. Pankaj.
So Aditya, I think we are at 1 hour mark now. And I know that this interaction is going pretty interesting. There are a lot of exciting, questions and information which are coming into the discussion. But I think we'll have to sort of park those questions for the next session.
I thought we were just getting started, Pankaj.
I know. This is getting really interesting. But I really appreciate everybody's presence and the interesting insights that our panelists have today. And definitely, we need to probably do one more session because I still see a lot of thoughts and questions in the chat. So we have to do another session probably in next couple of months and so on and so forth. But yeah, from my side, I really appreciate everybody's presence here. Aditya.
Thank you everyone for taking this time to join this panel. And the panelists, thank you very much for joining us and discussing and providing us with your valuable insights.
All the best, everyone. All the best, Aditya. All the best.
Thank you. And let's connect on LinkedIn or reconnect later so we can have more interactions. Okay. Thanks everybody.